All right, Jeff, if you want to take over from here.
Absolutely. Welcome back, everyone. And if you're here for the first time, welcome. This is the weekly JAWS group training. You probably know that much, but today we have guest hosts, me, I'll be moderating, and Brad Gilboe, who is a experienced and successful real estate investor. And we talked about a lot of things last week. And so one of the things I wanted to get started on today was just some Q&A from last week, and also encourage everyone to put questions in the chat. Like, as Brad has this ability to just talk without ever stopping for days on end. So if he starts doing that and you have a question, throw it in the chat so we don't miss it, right? And then I'll interrupt it and try and pry myself in there and see if we can get some of the questions answered that you have throughout the presentation today. So having said that, does anyone want to just take themselves off of mute and throw out a question that they thought of after last week's training? Bueller. All right, well, that's good. That means we answered all the questions. So that's
Jeff,
awesome.
I have one question. So how do you jump into 1031 exchanges to start investing?
Sorry, what was that first part, Tina? How do you do it?
Yes.
Well, so first thing first, I would get connected with a trusted 1031 exchange accommodator, because there's a lot of rules and regulations that you should understand. And then more specifically, something that you may not be aware of is what's called a reverse 1031 exchange, where instead of in a typical 1031 exchange, you sell your subject property, right? You have 45 days to identify a list of properties that you want to purchase, and you have 180 days to close on what is your up-leg property. With a reverse 1031 exchange, assuming you have the ability to financially, you can buy the property first, your up-leg first, and then you have a certain amount of time to sell the other property, if that makes sense, which is applicable right now, because if you're like many of my clients, selling your house isn't going to be the problem. It's going to be what's the thing that we're going to buy. So it could be a good strategy if and when you find your up-leg property off market, then you have the ability to do it. But the short answer is talk to a 1031 accommodator, because there are certain requirements. Like, you have to have, I think it has to have been like a non-owner occupied property for at least 2 years. You typically have to have like the same or greater mortgage or purchase price. I forget which one it is. So just know, and it has to be either like for like, or you've got to split so like, for example, you couldn't sell a 4-unit and then buy a single family home, but you could sell a single family and buy a duplex, or buy 2 single family homes or something like that. So just explain some of the scenarios with a 1031 exchange accommodator, and it's very inexpensive. I think it's like $600 or $800, but if you don't do it right, then you get hit with the taxes.
All right. Thank you.
Yeah, you're welcome.
It's a great question. I got a quick follow-up question on that. That trusted accommodator or a 1031 accommodator, I haven't heard that term before. Is that typically an attorney, or where do you source that person?
It's a total, I mean, I don't know, Google it, right? Like, I guess what I would say is that there's a guy out here that does everything. And I think it's like $600 or $800. And the accommodator, it's similar to like how like escrow is like that neutral third-party holding company for like transferring money and documents and sort of facilitating the sale. The accommodator works closely with escrow, because you can't commingle funds, and there are just certain things you have to do right. Like, what I would say, Tina, is just be aware. It's my understanding, it's very difficult to pull money out if you're doing a 1031 exchange. So oftentimes the money or the equity that you have needs to stay in the deal. Now, that's on the purchase side. So you could sell one and buy another. And when you buy your up leg, then refinance to do a cash out refinance, like that's all legal. But like on the sale part, almost, as my understanding, all of the proceeds need to go into that next sale. But it blew my mind to learn that it was only like $600.
That's awesome. Thank you. Thanks for that question, Tina. And yeah, thanks, Brad. So if that is, let me just check the chat real quick and see. Looks like, all right, we got no pending questions. So
I gotta follow up on that. Is it,
right.
are the 1031 accommodators like kind of like attorneys? Like, if you get a good one, they're great, or if you get a bad one, they're terrible? Or is it very like, is it a very rote process that's sort of cut and dry? Like, can you
Sure.
get on that, or is it like you gotta do some more diligence and find somebody that's done a bunch to find their guy, or how does that work?
I mean, I would never underestimate how people can be terrible at their jobs. So like, there's probably some bozos out there. So I would say, vet somebody. But like, where I'm at, like, there's one name that comes up like all the time, and then this person actually led a couple of. This is how I learned about the reverse 1031 exchange, right? Because most people just do. Oh shoot, are you guys okay? Oh, I hope I don't lose you. Most people just do the standard 1031. So I didn't even know about the reverse. And there's even like more complex strategies. And so there was a company that came and spoke, and it just turned out that he was like the authority on that subject out here. So I would just reach out to other investors. There's called like RIAs, real estate. What does it stand for? Like RIA meetups, or just like local investor groups, or
It's done
bigger pockets, or just, there's just different forums and things. Yeah.
Okay.
Awesome. Thank you for that question. And
I think I've got a wacky connection, so I apologize if that.
your audio is coming through pretty good. You're a little slideshowy, but you're good. I'm not concerned. So to start this today, our one of the subjects Brad had told me he wanted to share was just an overview of the bullet points of the 4 ways to make money in real estate. I believe Brad's reasoning for this is people can be short-sighted, right? They're only thinking of the appreciation play, or they're only thinking of, is it going to cash flow or not? And there's actually 4 big rocks when you're considering the 4 ways to make money in real estate. And that's the first topic of the day. Brad, take it away.
Yeah, and look, and all of this, the starting off point here is like, you really wrong, and just encouraging you to take action. So don't think like this needs to be something where firing off of this property. And the big takeaway is, even if you don't totally get it right, time really, in addition to all wounds, it also like makes any real estate deal like great as well. So I'll share my screen with you here. Can you guys see this?
Yes.
Okay, great. And if I'm on a bad, well, hopefully we just move forward. If you need to message me separately, if my connection is really terrible, I'll try to jump on my phone. So make money. Cash flow is the easiest one, obviously, right? Like, it's whatever your income minus your expenses, whatever's left over is your positive cash flow. Now, keep in mind that over time, rents will increase. So you should be making more cash flow. If you're locking in fixed rate debt and rents increase, then your margin of the cash flow will increase each year. Appreciation is pretty straightforward, right? Your property is going to go up in value, and especially if we're anticipating maybe some hyperinflation, or at least like on pace with what we've experienced, then appreciation is where your property is going up in value. At the same time, you've got your equity or the mortgage pay down. So your tenants are paying down. So that gap of the equity you have is going to be increasing, right? Like, as your tenants pay it down every month. And then depreciation is what we loosely talked about, which is the cost segregation or the accelerated depreciation, because there are tax benefits to how you make money. Now, these are non-owner occupied properties, right? Because if you're looking at this, of these 4, really the only way that you make money on a primary residence is appreciation, right? You're not making money on the equity pay down, in fact, because you're paying the interest and you are the one that's paying that down. And there's no cash flow because you're paying for your primary residence, and the depreciation isn't quite in the same way. So this is also really helpful. And a little bit of an aside, the way that your primary residence makes you money is when it goes up in value. And it goes up in value based on the market. So my point is that your property will appreciate whether you have a loan or whether you don't. So whether it's leveraged or whether you've paid it off makes no difference in terms of the return on the investment. Now, you could make an argument against, if you wanted to borrow money to then, like, you borrow money at a fixed interest rate, you could go and invest it elsewhere. Cool. You could also make an argument like, well, I just sleep better at night knowing emotionally in my heart that my house is paid off. But this is a common discussion about, should I pay off my house or should I not? So like, for my wife and I, I'll probably never pay off my primary residence. And in fact, I'll just refinance and or like get a line of credit to use the equity in my primary residence to then go and buy other properties, if that makes sense. But my point is this, like, even if you're buying a property where, well, perfect example, like this property in Arizona that we'll talk about in a bit, I ran my projections based on cash flow at like $950 a month. By the time we finished, the rents were pretty confidently at $995. And then I have had 2 people that have moved out even in the first 6 months. And we rented them at $1,050. So I'm already $100 higher on basically all of the 1-bedroom units. So now I can comfortably raise the rents, if that makes sense. But my mortgage is already locked in at that lower fixed interest rate. Does this part make sense?
Mhm.
Cool.
Yeah.
So even if it isn't like
money going out in super layman's terms, the money going out doesn't change, or if it does go up, it goes up incrementally with a little bit more property tax and a little bit more maintenance, but not exponentially. But the rents are going to outpace that. So your cash flow is going to grow every year as long as you're raising the rent.
That's exactly right. And then the other part is, if you're someone who wants to be utilizing the equity with some kind of a cash out refinance, well, over time, the value is going to go up, and then your mortgage is going to go down as your tenants pay it. So now this gap, right, like your difference between your equity and the value, that's the money that you could borrow against to then go and get something else if you wanted to.
Do you think that's a good place to expand on return on investment versus return on equity? And should we be comparing those or even thinking about those at this point?
You know, it depends. I mean, I guess if you want to get in the weeds, then sure. What I would caution you to say is, like, don't get hung up on that, right? Like it's sort of like a rich person's problem, right? Or a champagne problem, I guess I'd say. So it's like, if you're at the point where you're like, man, am I getting a good enough return on my equity? Well, then congrats. Like, you own at least one or several properties, and now you're worried about like your internal rate of return, which is awesome. So that's more about if you want to balance your portfolio or figure out some of these things. But at the end of the day, if you're someone who's even answering these questions and you're presented with these situations, like, you're doing better than most, is what I would say.
Okay, great. We'll save that for part 3.
Okay. Yeah. Great. Perfect. Okay. So, yeah, I don't know. I mean, this is, I guess so then my point is, like, this is why time works in your benefit here. Like, you cannot go wrong. I mean, everybody probably, well, not everybody, but if you're a real estate agent and you've been doing this for a minute, you can probably think of some piece of crap house or even some great house that at the time you were like, nobody will ever pay that, and yet somebody did. And then now you're looking back and you're like, holy cow, I wish I would have. Especially in this market, like with us, we have people that are in appreciating areas, or areas that were like, you know, sort of on the cusp of transitioning, or even just like something close to the water, like depending on where you're at in Jersey, right? Like, you're like, it's somebody was like, man, I'll never pay that, and yet somebody did, and the market continued to outpace, and now that person has that asset, right? And they're able to do whatever he, she, or they want to do with it, which is refinance it or sell it and trade up into something else, or just keep it and keep the cash flow. So you really can't go wrong by buying real estate, is I guess what I'm trying to say. And it's somewhat idiot proof, as long as you purchase conservatively and you can hold on knowing that the market's going to fluctuate. But if you can hang on and keep to make those payments, then over time, like, I mean, it's just gonna be the biggest wealth builder. So.
Okay, so I got a 2-part question on this. One is, I'm looking at a specific area right now, and I was running some numbers yesterday, and I use at one time I Googled rental property calculator, and a really good one came up, right? It has every bracket on there that I can think of. Actually, you know what? Let me share my screen really quick and I'll just show you. You'll stop sharing. And I just want to get your opinion on this. All right, can you guys see my screen?
Share that house.
Okay, there we go. Got this thing in this.
What, Zoom is turning into Peloton?
Yes, thank goodness.
Oh God.
There's Google rental property calculator. I think this is the one that came up. Yes, here we go. So calculator.net is the website. And this thing is great. Like,
Yeah.
purchase price, down payment, interest rate, and then it goes into the property tax, which in the county I'm looking at is in Indianapolis. So I was able to figure out their property tax pretty easily. I stuck with the $800 insurance because I didn't feel like researching it last night, what it would cost to insure there. HOA is listed on Zillow. Maintenance, I left it 1,000, and other costs I did for capital expenditures, which was another 1,000 a year. Let that build up.
Yeah, this looks right. So generally speaking, I typically put, I mean, whatever your property management fees are, you'll have to look in that area. So you've sorted that out, maintenance. For vacancy, if it's like, I mean, 5% is pretty standard, especially for multi-unit. You could maybe do a little bit more. That's the killer. Vacancy is always the killer. And then I put 3% for repairs, 3% for capital expenditures. And then there could be other stuff like, you know, other costs, like for example, whether you've got snow removal in Indianapolis, right? Or maybe if it's a single property home, your taxes include the trash. But like when I bought that commercial building, I had to pay for trash. I hadn't really thought about that, right? So there's also like a master water line maybe, or like a master electric if you have to submeter that stuff. But yeah, this is great. I mean, generally speaking, property management, repairs, capital expenditures, and vacancy are going to be the main four, in addition to like other utilities and things.
What do you put in for property management? I mean, I know it varies by market, but just like.
Yeah,
Like,
it really does. Like in Arizona, I've got like a flat rate. I mean, in Michigan, I pay 10% on one property, but it could be less. Out here in LA, you're going to pay anywhere from typically 8%, but it could be 6% just because the rents are more.
and then I guess I would imagine this varies too. I've got one duplex. We've owned it for 10 years. I'm the property manager right now,
Yeah.
and like. I'm just wondering if I paid somebody 10% of the rents, and then I'm assuming my understanding is like, it's like, oh, if it's under $500, we just do it and then send you an invoice for it. If it's over 500, we call you with 3 quotes and you make a decision or something like that. Like,
yeah, that's right. Although I set mine for like 150. And the other one note about that, I have several properties that I also manage myself. I still run my numbers with the property management fee in there because at some point I would like to remove myself having that job.
right, and you're theoretically paying yourself to do it as you go or whatever. At least in.
That's right. Yeah, I don't want. It's like, look, you don't want to be reaching. Like I don't want the numbers to only work if like every single thing goes according to plan. It's like I'd rather make it where, okay, you know, I can't do this every day or whatever, you know. And to be fair. Look, all these horror stories I think are very sensationalized. I've never had any issues. I shouldn't say never. I mean, in my duplex, I had like, they flushed the toilet and it like leaked into the lower unit, but like I called insurance, we got it figured out, you know, my house here, like things break, like it's not the end of the world. So that whole, like this fear that like, oh, I'm going to have these nightmare tenants that just bug the heck out of me and I have to go over there and change the light bulbs. It's like, no. Like there's always somebody that can do it. Right. So
you think that this free rental property calculator is a great place for just a quick pro forma on a property? You'd be comfortable using these numbers? Okay, cool. Yeah. And then just to show you something really quick, and then we can get off this. Last night I was looking at a particular county in the Midwest, and I did it as like worst case scenario. Okay, like zero money down, $250,000 house, which would be paying full retail for a turnkey property with no, you know, not leveraging anything. And then $1,800 a month is kind of the low rent I could expect, like worst case scenario rent. Management fee 8%, which from what I've read and some calls I've made is accurate. $1,000 a year in capital expenditures, which sounds like you said was a little high. $1,000 a year maintenance, HOA, total insurance, everything. Okay, so like this is like, I'm not buying it right. I'm not getting maximum rent, and I'm not putting anything down. So the first year it would negative cash flow $315, but by the next year it's breaking even, right? It's $92 a year I'm making. In the year after that, so your point of time cures all, like that cash flow annually just by raising the rent 3% a year, which isn't outlandish by any means. You know, every single year this thing just keeps growing and growing and growing, and by the end of it, I made $790,000, right? And someone else was paying that mortgage the whole time. So
Can you go up to the top? So Brad, like what's your eyes on this when you get to, I mean, 34% per year sounds insanely awesome.
Well, that's the internal rate of return. I think, look, this looks good. I think to Jeff's point, like, look, it's not cash flowing, right? So whatever money he has to put in, which in this scenario, he's putting zero money down. But if you were if he did have to put 25% down and he's getting no return on his money, then that's different, right? Like oh yeah, click that. Let's just see.
So with 25% down, so now because
Okay.
zero down, that number was out of control.
Yeah,
Go.
IRR, that's a weak spot in my understanding. What do you focus on when you look at this? Especially if somebody's just starting out, which is probably most of us on this call, like, are people focused on cap rate, or they want just cash flow, or how do you think about that over time? Of like, okay, this is what your scenario looks like if you make them conservative. I
Yeah.
want this to be at a certain threshold, or how do people think about it?
Not to sound dismissive, but it depends. And so what you need to do is figure out like what your goals are and what you're working towards. And so let me expand. Originally, I was looking for cash flow, right? Markets that would cash flow and appreciate. So I was looking out of state. So I was like, okay, great. Again, I want to get cash flow. Always want to be mindful of cash flow. Well, then I realized like that isn't as big of a deal for me. While it's certainly great, I didn't want to say no to opportunities that would come up in LA that were more of appreciation plays, because as we talked about before, it's not like the cash flow is not meaning to subsidize like a job that I am not happy with, right? Like I like what I do, and I'm not trying to get my wife out of her job. So I don't need the cash flow to sustain my like cost of living right now. So I can afford to, like with the property that we walked through last week, to do a refinance and leave money in the deal, because I don't need that money right now for something else. So for me, I'm trying to look at where are opportunities that I can add value, like, creating equity, and also like higher appreciating LA spots that I can use the tax strategies to save with, fortunately with my higher income being in LA, that at some point over the next 2, 3, 5 years, I'm going to sell those and then trade up into something that will give me cash flow, if that makes sense. So instead of focusing on, like, I was working towards getting to like a $10,000 a month in cash flow, right? So where I would have 120 grand a year, meaning I could effectively be financially independent. Well, now I'm like, well, wait a minute. I don't need to make an extra 1,000 or something per month right now. If I can make a smart buy here, then in 3 to 5 years, then I'll have the cash flow when I sell that appreciation play property and then focus on cash flow. So I don't know if that answers your question. It shifted for me. I was focusing on cash flow originally. Now I'm just looking for the right opportunities here locally, but also still looking out of state.
Because you're thinking like, yeah, I make my income through my day job. And I'm doing this investment stuff to stack wealth, to build wealth, and then eventually I'll trade all this into a complex that will be the cash flow that I'm really looking for, as opposed to like, I need that cash flow today because I'm trying to quit my job.
That's exactly right. So it's like, yeah, that's exactly right.
And you got first world problems with trying to figure out your tax strategy on your income today. And
right.
That the appreciation type stuff or accelerated depreciation helps you, is a stronger play for that.
That's exactly right.
If you were just acquiring more cash flow, you'd have more money to be taxed.
That's exactly right. Yeah. Yeah. And also, so like, that's also why like $135,000 duplex in Michigan that I bought a few years ago, there's no accelerated depreciation there, but $1 million home in LA, I've got a lot of depreciation. So that's why, like with that specific property, it saved me $85,000 in my taxes. That's a heck of a lot of cash flow. I mean, what does that work out to be? Like, whatever, 8 grand a month or something, probably, or less than that, but still. So my point, or 7 grand a month. But my point is like, it depends on your situation. But if I was only like, no, like, look, we just want to get to the point, we've aggressively paid off our primary residence. Our kids are grown, and all we need to do is earn $4,000 a month, and then we can go live in a van or travel or do whatever we want to do. I think cool, right? So, that makes sense. But, originally I ran a scenario where I was like, okay, cool. In 5 years, or 10 years, sorry, if I could pay off my primary residence and convert my garage into an ADU, I can rent that for $2,000 a month. That pays for my property taxes and insurance of my primary residence, which I now own outright. And if I have $10,000 a month in cash flow, we could just travel and just live off of 100 grand a year and travel. But this was like when I started all of this stuff, whatever, 3 or 4 years ago. Now I'm like, oh, we're having a baby. And I was like, well, all right, that might be a little tougher. And then I'm like, oh, I don't ever want to pay off my house. So my point is that things have changed, but only because people are just poking holes in my plan and then challenging me on what's actually important. And then my wife and I could figure out what we want to do. So that's why I mean, like, it depends. You should have a discussion about what's important to you and, any of the decision makers in your world or your, go from there.
Brad, I have another question. So every time you refinance your house or one of your houses and you have the closing costs, which vary in New Jersey anywhere from $3,000 to $10,000, can you reduce that on your taxes somehow, or is that somehow deductible?
I think so. I mean, I'm 0% qualified financial person here, but yeah, I think that any of the closing costs you can write off. There's little loopholes. Like, for example, even with my home equity line of credit on my primary residence, it's an interest only line. And if I borrow money on it and then purchase investment properties, I can write off the interest on my taxes because I'm a real estate professional. If I used it to like buy a boat, I could not do that. So I would talk to your CPA because yeah, the closing costs are definitely. Oh, did I freeze? You there?
A little bit, but I think we got you. That basically that's a question for a tax professional and tax advice. Maybe not the best thing for Brad to share. So one last thing on this little calculator I wanted to share, that kind of about our conversation yesterday, Brad, about you just start hitting singles and the home runs will come. So I just quickly went through this and went, okay, these homes retail for $250 that I'm looking at, and I would be thrilled. It would be a home run if I could get one for $235 in this market, right? And rents are around $1,900, so $1,800 was my worst case. I would consider it a home run if I got $1,995 for it, right? So let's say, okay, I have 25% down. I got a deal on the house. I maximized rent. This is a home run. The cap rate was 5.4 on the one where it was realistic, and it's 6.65. If I'm waiting for a home run before I do anything, it made a 1% difference in my cap rate, right? Like, and I missed out on all those growth opportunities that start as soon as you start. So just kind of a little aha I had playing with this calculator, that like, if you're waiting for a home run before you swing the bat, you might be waiting a long time.
And the other thing that was a big aha for me, I've been trying to buy our second property for the last probably year and a half and waiting too long and probably, missing opportunities or whatever. But like, I'm just running these scenarios. Like, I try to find out like, all right, well, where's break even? Where does this deal break? And like, what's in purchase price? So, I'm negotiating or trying to like acquire the property and repair estimates and stuff. I had one property that was like gutted on one side of the duplex. I'm like, all right, well, the repair estimate was way too high than I thought, and blah, 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 blah. But when you look at the interest rate that we have right now, like the interest rate was the thing that moved the needle way more on cash flow and the long-term play on it. Is that how you think about it, Brad, as well? Like, just smarter to be in the deal with a cheaper interest rate because that's such a factor, or am I thinking about that correctly?
Again, it depends. So what I would say is don't bank on appreciation. I wouldn't buy something that doesn't cash flow, right? Like, I wouldn't buy something that was costing me money every month because I think that it's going to appreciate.
Right.
Now you could keep money in the deal if that's something that like works for you. So taking a step back, like what I usually do is like, I try to look at like, again, what's a realistic scenario that's going to play out? Like, what do I think I can sell it for? What's it worth when I'm done? Rents, and I back out all the taxes. That's what determines the purchase price. You don't work it backwards. You're like, okay, well, if I can get more rent, and if I can renovate it for 30 instead of 40, and if like, no. Like, if you get into that game, like, it gets a little tricky, right? But what I don't want you to do is like, in this scenario, and maybe I'm fortunate because we live in a higher cost of living area, but like, there's times that it's like, I'm not going to let this deal go for like 5 or 10 grand, right? Like 5 or 10 grand, 12 years from now, I'm going to be like, why was I being so short-sighted? So not to say that, 10 or 12, 5 grand, maybe a very like significant amount of money, like in your world right now, which is totally fine. Like, starting out, like I was in the same boat, but like, so I guess what I would say is it's like, I want to look at like the merits of the deal and just like, do I believe in it? So with the deal that we have here in LA, it's like, even though I'm only making a few $100 a month, that neighborhood, I'm just so bullish on that neighborhood that it's like, even if I'm breaking even, which I'm still making money every month, I just know in 2 years when I go to sell it and I have the tax savings, it will have absolutely gone up in value. And so like, I'm a little bit more comfortable locking in that fixed interest rate like you're talking about, and then finding a way to make it work, but not where I'm like, it's getting riskier. Does that make sense? Right? Like if you're stretching everything to make the numbers work, then you're like, man, this is okay. It's not going to work.
So if that, I think we're at the 30-minute mark. So I think we should jump into the other subject we wanted to cover today, which was basically, in your own words, a home run, your Phoenix property, which came after being in the game for a while, and the kind of the Burr method of that one.
Yeah.
That's where we want to go, is kind of cover Burr on this kind of home run deal that you've put together.
Yeah.
In Phoenix.
Stop.
Yeah.
Yeah. If you can stop your share and then I'll share mine.
Yeah.
So man, this taught a couple of things. So first of all, the Burr strategy, if you're not familiar, it's B with 4 R's. And what it stands for is buy, renovate, rent, refinance, repeat. And so it's a way that you're putting sweat equity or rather like capital into a deal to force the appreciation to then refinance out all of your, or a lot of your money to then do something else. So like in rough numbers, let's think of it like this. Let's say you could buy a property for $50,000. You could put $25,000 into it. And when you're finished, it's worth $100,000, right? Very simple math. So your purchase cost is 50, you're putting 25 in. So now you're all in for 75. And let's just say you're paying cash and now it's worth 100. Well, the bank will say, hey, this property is worth 100. We will lend you up to 75% loan to value. So you can refinance with a cash out, pull out that 75 grand, get out all your money back. And in theory, on a $75,000 loan, if that market will support your rents, like meaning if you could rent it and it cash flows, you get all of your money back. You now have 25% equity in the deal that is not your own money that you created, and you've gotten your money back with now a cash flowing asset that's totally renovated, that is rented, and it's basically doing all the things you talked about: appreciation, equity pay down, yada yada. But does that part make sense at first? Like you're renovating something and adding value. Are we tracking that?
Yes.
Yep.
Okay. So what I did is I was like, well, let me apply this and see if I can find a property. It was actually like a small apartment building. And so, hang on. So the rough numbers were this. So I bought this property for $760,000. Might have been a little bit less because I think we negotiated a sewer replacement or something. At the time, it was a sober living facility. And so we thought there were 9 units. It was 7 1-bedrooms, a 3-bedroom house, and then another structure that was like 4 bedrooms, 2 bathrooms, which I later found out was actually a duplex. So they didn't know that. So it actually turned out to be 10 units, even though they were marketing it as 9. So the closing costs were 40 grand, and half of these units were already gutted, right? Meaning, I wish I had photos, but I don't. So half of the units like didn't even have kitchens. The bathrooms were demoed, which is perfect for me because I wanted to redo everything anyway. So my renovation costs actually went a little bit higher, but like rough math, I think it was 460 when we started. So I was all in for, let's just say 1.25. Now, I don't know when the last time I updated this was. This is the one that the rents are a little bit higher because I'm actually earning like 11,000 a month. So whatever that is, 11,000, oopsies, hold on. 132. So I'm earning a little bit more than this, and my annual expenses are around 28. So if my net operating income, which is gross income minus expenses, is 99 grand, then with a commercial property, the value is almost always a multiple of the NOI, the net operating income. And so at the time that I purchased, things were trading at a 6.5 cap, which would have put this at 1.6. And then by the time I went to go refinance it, like it was actually like things were trading at a 5.5 cap. So I hope you're following here because I tend to get a little nuts with this. I'm all in for 1.2, right? My cost is 1.2. This thing is, it appraised at 1.6. I could easily sell it for 1.8, probably $2 million if I install this security gate and something else. So Now, when I went to go refinance, the bank is going to lend me off of this number, right? They take the NOI. That's how they determine the value. The bank that I got was a little bit more conservative, so they only let me 1.1. At the time, I had 750 was my current loan balance because I had already, that's just what it was. So I ended up getting $350,000 back to me. And then my monthly net after expenses was like $8,300 minus like whatever my PITI, which is my carrying costs on this. So basically I'm positively cash flowing $2,500 a month, but I have to keep 150 grand in the deal, if that makes sense, right? So let's take a step back because that was a lot. I bought it for 750. I put 500 grand into it. I'm all in for 1.25. It's worth 1.6 to 1.8. The bank says, hey, if it's 1.6, we'll give you 75% of that, which then worked out to be, well, they ended up only giving me the 1.1. At 1.1, with all of the costs on the mortgage, I think it's like whatever, 5 grand a month or something, plus my property management fee, my vacancy, all of the buckets that I need to do, I'm still making $2,500 a month. So I had to keep the 150 in the deal. 150 in the deal, meaning I spent 1.25. I only refinanced 1.1. So 150 grand of my own money is in the deal. But let's look at what I'm getting for that. For the 150 that I'm keeping in the deal, I'm getting $2,500 a month or whatever, which is basically like a 20% cash on cash return. But also I've got, if I owe 1.1 and this thing is worth 1.6 to 1.8, I've got somewhere between $500,000 to $700,000 in equity I created. Like that's the real value, right? Like I created that value for renovating the property. Now it's gone up because of the neighborhood and a handful of other things. So if somebody were to say to me, hey, Brad, if you give me $150,000, I will give you a fully renovated 10-unit apartment building in Phoenix that's in a appreciating market, and you'll make $2,500 a month, and you're going to have $500,000 to $700,000 in equity. Would you want to do that deal? 100% I would. Like, why would I not want to do that? So this is what I'm saying. Like when you focus on the refinance element, don't get too worried about pulling all of your money out. Now, as an aside, this bank was being a little bit conservative. They're actually going to increase my line of credit another 100 grand in a year, which I just refinanced this in April. So the reason they wanted to do that, because they wanted me to have some skin in the game, which I thought was ridiculous because they should just lend to me off of the asset. But they actually didn't want to do that because they just wanted me to have personal money in the game. But I did my cash out refinance after I had rented it only after like 2 months. So it wasn't like a seasoned property, as it's called. So my point is, I thought that this was going to be like, okay, and I was going to have like a little bit of money and maybe break even on the cash flow. And it turns out to be like insane, right? Like I'm making 30 grand a year, positive cash flow. It's going to continue to go up. But here's the crazy part is it's like, in another year, I could refinance and pull out even more money out of this deal that I don't pay taxes on, right? So if you're refinancing on a cash flow, if you're doing a cash out refinance based on the equity of your property, you don't pay taxes on the money that you take out. You only pay taxes on taxable events, which are like sales. So when I go to sell it, if that's ever something that I want to do.
What? Hold the phone. Say that again. What? You don't pay tax on what?
A cash out refinance is not a taxable event.
You're just borrowing money, right? You're not selling a property and
Right.
receiving a lump sum. You're
Yes.
borrowing money, so it's not a taxable event. Where if you sold it and got that money, that's a taxable event, right? Is that
So this is the compounding effect. So now I take this 350 grand cash or whatever I did, and I go buy another property. So now property A is still cash flowing, going up in value. The tenants are paying it down. And when that gap gets bigger, you do another cash out refinance and I take out 100 or 200 grand. Then I go buy property B. Well, property B is now going up in value. Tenants are paying down the rents and I'm increasing that equity. And at some point I can refinance that out, right? The only time I would sell property A is if I felt like, one, I could get a better return on my money, or if the time had come that I had fully depreciated it and I had another way that I could like spend that, that I could invest that money to get a better return. So at that point, like, yeah. And then when I go to, if I do a 1031 exchange, then you're not paying the capital gains, you're just trading up into property. And then at some point I'm going to die and I'm either going to leave it to my kids or my kids will get that inherited basis.
Or your best friend, Jeff, whatever.
This is how the wealthy get and stay wealthy. When you get this, you're like, I'm sorry, come again? Tax-free cash out refinance, and you can use these tax strategies so that you're deferring the capital gains. Like, this is how wealthy families and people that understand this, like, get on the roller coaster and they end up just staying on it.
That's awesome. I have a quick question. If we can go back a couple steps. So while you were renovating these 10 units, there was a cost of ownership during that time. Is that that 500 grand that you put into the property? Are you calculating, at one point you were not making money on this because there was no tenants.
Over a year. The rent, so let me, all right, yes.
Is
the
that
answer.
calculated in to the 500,000?
It is because of the type of loan that I got. So this is all the, where's my other slide? Here's your core four, which is also from the long distance real estate investing book. You've got your agent, you've got your lender, your contractor, and your property manager. This is really all you need. So in Arizona, I had an agent. He was very green, meaning like he wasn't a savvy investor. Great agent, but just wasn't quite familiar with what I was doing. But I trusted him. He was a buddy. So I said, hey, man, here's kind of what I'm looking for. He sent me that deal. I was like, dude, these numbers sort of pencil out. I'm interested in at least making an offer. So I make an offer and then they accept it. Then during my due diligence period, I flew out to Arizona to do my normal inspections. This is the time my agent is also works for a property management company. So I met with the property manager and poked a bunch of holes in the deal to see if my expenses all checked out, which they did. He introduced me to 3 different lenders and 3 different contractors. One of the lenders, none of the lenders could do it because they just, I don't know why they couldn't do it. I probably had no experience, and I mean, there's a number of reasons why. But I ended up getting connected with a guy that worked with a local bank, and he was like, oh, we can do a construction loan here. What I thought was going to happen was that I was going to have to come up with 20% down on the 750 and then cash flow the 400 and something $1,000 renovation. What ended up happening is they said, hey, this whole thing is going to likely be around 1.2. Why don't you just come up with 20% of the 1.2 and then we'll just do draws and we'll give you a construction loan. I was like, this sounds amazing because yeah, I can basically do all that. So I ended up getting a construction loan where there weren't any fees associated each month. Like I wasn't paying those things. It was all just due at the end. And so the expectation was that I would refinance at a certain point and then convert that construction loan into like a conventional loan, if that makes sense, Jeff. So my point is that just by going out and meeting with people, and this goes back to like, if you remember on another call, I was talking about like, I don't have any ego. So I'd go and sit down with these people and be like, hey, my name is Brad. Here's this property. This is what I'm looking to do. And I feel like it's possible. Is this something that you're interested in? And can you explain it to me? And I got 3 different no's from the people I met with face to face. That doesn't even include all the no's that I got when I was getting started. But then one person was like, hey, I can't do this, but I know this other guy that, you know, specializes in these sort of like multifamily construction loans. You should speak with him. And it turned out that he was the guy that had this loan product available to me. And then, yeah. So then to answer your question, there were no carrying costs for me. I just did this. And then I had my contractor and we broke down like what we thought. And granted, it took longer. So like, you know, and we went over budget, but these were like intentionally upgrades that we chose to make. And I would have done that again, because originally our budget was like 380. And I think we ended up spending 460 if you saw or something. So my point is that it was like, I didn't have to have all the answers at the time that I wrote the offer. And during my due diligence period, which I think was like 21 days or something, we inspected the property. I walked through the contract. I got 3 different contractor bids and chose one that I liked. You know, I met with different lenders. I met with the property manager. And then I really like refined my pro forma, which is like my property analysis. So then it was like, if you remember from before, like a realistic best case, realistic worst case, and then my sort of like home run scenario. And I'm exceeding like my home run scenario. So did that answer your question, Jefe?
Yeah, totally.
So am I understanding the timeline correctly that you ended up finding some of these people like after you had it under contract?
Yes. Almost everybody. I don't know that that's possible now. I mean, just because of the nature and how competitive things are. Almost immediately after buying this, it started to the point that like distressed multifamily were going all cash, like, you know, like off market. Like I almost immediately started getting beat up. And I bought this property for 750 and another piece of crap sold for like 1.1 like a year later. So I was like, oh man, I got a screaming deal. But again, it wasn't like, not to say that these things don't exist, but this is my point is I was like, well, what if? I was like, what if I could make it work, right? I mean, half the units didn't have kitchens, but I wanted to renovate it anyway. And then the bonus part was just like during our inspections, that's when I realized like, oh wow, there's actually 10 units here. Like we could make this other structure a duplex. So then I basically got like another $1,000 a month out of it.
So how many doors did you own when you took this property?
3.
Before-
The
So
right before this, I bought my turnkey duplex in Michigan. And prior to that, I had just a single family home that I bought for $80,000, right?
the reason I ask that is just, it's easy to get discouraged when you say something like, I don't think that's possible today to find all these guys or get this deal. But the point is you had gotten into the game, you'd hit a few singles, you had read the books, you had listened to the podcast, and when the opportunity presented itself, you were ready. And like the singles are still available today, 100%. We just proved that on that property mortgage calculator, right? Like we should all probably start, if we're not already starting hitting singles now, because these opportunities will come back. And if we're ready, we're gonna pull a Gilboe.
Yeah. So you're exactly right. I basically I had a harebrained scheme. I was like talking to my wife and I was like, babe, I want to do this BRRRR strategy. I think multifamily is the way to go. I was looking in Tennessee, Indianapolis, and Arizona. She happened to gravitate towards Arizona because we had family there. And then I reached out to my buddy that was the realtor. So I was sort of loosely exploring all 3 markets. And then this thing just kind of came up and I was like, man, this seems like interesting. And here's another point. Like they had another, it was listed at 760. And my realtor was like, man, we could probably get it for 727 this. And then I was like, no. This is where me being the realtor made sense. I said, we're financed. We're not effing around. Like just give them what they want. That doesn't matter. And they waited another week or so and they had a couple of investors that were lower. And he was like, dude, they're not this high. And then I was like, you don't understand. This is 760, 740. You're too, this is myopic. I'm thinking big picture, right? So I wasn't trying to lose my brain or lose my deal rather over getting too in my head over an extra 10 or 20 grand. You get what I'm saying? So like, to speak to your point, Gil, like, that's what I'm saying. Like, if you're like, man, even the other flip that I bought in LA, like, that was originally, I wanted to offer 775. I paid 795. And I was like, fuck, 20 grand is a lot of money, but also, who cares? It's like one more house I got to sell, or I don't take a commission on this deal or whatever is the case. And at the end, it's like, it worked out really well. Right. So don't be too short-sighted thinking about a few grand here or there if you see the bigger picture, if that makes sense. So anyway, the point is like, dude, people call me all the time. Like I couldn't buy this deal now just because Phoenix has blown up, as I'm sure have many other markets. But the point is that just echo what you said, Jeff, like I had no clue whether this was going to work, but like, $120 flight out to Phoenix, $600 in inspection costs. And then a bunch of, I rented a minivan and drove around and met with these people, to the like lenders and property managers and different people just to get educated. There was a very good chance that I was going to realize like, oh, this is not a good deal. But when the property manager, the guy that was like the broker of the firm that my buddy worked at, and he was just like, hey, I was like, man, I don't know. And I think this makes sense, but what do you think? And he was like, well, do what you want to do. But if you're not going to buy it, would you assign it over to me? Because I want to buy it. And I was like, okay. So that's like kind of all I needed to hear. Because I tell people that all the time, right? Like, hey, I hope 100% you can buy this. These are clients in LA. 100% you should buy this. And if you can't, please don't tell anybody else and just call me right away. And then I'll buy it. And that's not like a sales tactic. I'm like being truthful. Like, I hope they make it work for them. And this other property that's going to be a single family home that I'm building 3 units on, this agent brought it to me and I was like, you and your wife should for sure buy this. And then he couldn't do it. And then I was like, okay, I hope you can. I'm happy to help you explore every way. But now that you found out you can't, please don't tell anybody else about this. And I'm going to come in and buy it. And then it was serendipity. It turned out that the grandma lived there with the grandson. The grandson used to go to school with my wife and like knew who she was. It was like a whole like weird sort of very coincidental thing, and we bought that property. So
How this, to kind of go back just a little bit. How big of a deal was it that this place was vacant? That it was previously a sober living, and that meant it was totally vacant?
Yeah, at the time that I was buying it. So that's also the benefit of on a commercial. They only value it off the assets. So what I needed to do when I was meeting with the lender just wants to show us like, hey man, how are you going to get from A to Z? And I could say, okay, here's the scope of work from the contractor that shows how we're going to break down of all the renovations. Here's an analysis of the rents, all the carrying costs. Like this thing is going to cash flow. It should be worth more than what we're putting into it. And then they just had to buy into the vision. And then there's a checks and balances, right? Like I had to apply for draws and I had to do some different stuff. All of the overages on the renovation, I had to foot the bill on because I couldn't go back and like amend the draw. So, I ended up spending $80,000 of like my own money. Well, not my own money that I drew on my home equity line of credit on my primary residence, right? So I just used my own lines of credit when I finished everything. And then I did the refinance and took this money out. I just paid off my HELOC. So, my point is that I got the lender on board with that construction loan product, which exists. I mean, there's some people, and I hear about this all the time, like local banks that will lend off of the ARV. So if you can, again, let's just say there's $100,000 house and it's worth 100, but you can buy it for 60. There are banks that I hear about that will lend you. You don't have to come out of pocket any money because the 30-40% equity is enough for them to like stay interested in the deal. So
Would you have continued exploring this deal if there was 10 dirtbags living in the units?
Well, I mean, yeah, I would have. My plan was to get them out of there, or at least like renovate them. I mean, sorry, my plan is
maybe I'm focusing on the negative too much, but evicting people, even with favorable laws, can still be extremely challenging. And is that a huge calculation in this, or do you even just let the sheriff?
It is. I mean, so ethically, for my wife feels much better about properties that are vacant because she doesn't like to be the one who's like kicking people out on the street, which I don't want to do either. But I also like value add. And so we look for properties that are like really run down. And truthfully, like this one, no one would want to live there. So it was easy. But I looked at another property that like all of the units were older, the ACs were broken, half the wall units didn't work. And it would have been a play where we would have like raised the rents slightly when there was turnover, renovated those rents, and then given people an opportunity to move into like the nicer units. So, I mean, I want things to be fair market value. I'm not trying to totally, gouge people here, but like at the end of the day, like, I want to get like a fair product. So, to answer your question, I probably would have taken it on if there was an opportunity there. And even other properties that we've looked at have been the case. In LA, probably not. But Arizona is like very favorable for landlords, not so much tenants.
Cool. That's awesome. That's it for my questions, but I've asked all the questions. I just want to make sure that no one else has a burning desire to ask a question. We have about 5 minutes left. So anyone?
Sorry, let me just say one other thing about this. I like this. It's very active, meaning like I like the renovating, like adding value and doing these things. I'm doing a deal with an agent right now that she owns 30 doors here in LA. And she doesn't want to do any of this stuff. She only wants turnkey, like mint properties. And she just buys those. As she gets more money, she buys them. She's not interested in creating equity. She's not interested in cost segregate. She doesn't care about any of that stuff. And she's very wealthy just because she bought over time when she had deals. So don't think that you've got to be super involved in doing this. I'm just saying, if you're a little bit of a go-getter and a hustler and you like the idea of being able to recycle your money, because all the money that I used for my down payment and the renovation with the refinance, I get all that money back. The asset, the property, pays off all the loans and gives me a little bit more every month. But then the few $100,000 that I put into the deal, I can now use to go buy another property. And so like there's a power for me in terms of creating the equity and then also recycling that cash, that this is why this strategy is very appealing to me. But don't make it seem like you got to do this. Like remember, the first deal I bought was a turnkey duplex that I didn't need to do a darn thing except change the locks, right? So like, to go back to what I said to Gil, like it really depends on your level of involvement, what's important for you. If your wife is on board with you being a crazy person like mine is, or if they're like, no, we ain't doing this. Like, could I take this on with my baby that's coming in 6 months? No, my wife would murder me. But like right now, she's like, all right, go do it, whatever, So that's what I want to say. Like really the biggest thing is just take action and find out that when that opportunity comes to you across your desk, ask yourself, should I buy this? Or should I, can I figure out a way to buy this and keep it, flip it, whatever, cool. And then more importantly, if you're like maybe Gil is, or someone where you're like, you kind of have an idea like, okay, I'm looking for that next property, then just get clear on what those criteria are and then just take some steps to find it. Maybe it's talking to 5 brokers and letting them know what you're looking for. Maybe it's like getting on an MLS drip campaign. Maybe it's talking to your title rep to find non-owner occupied duplexes in the zip code that you're looking for. And then you put those people on a mailer. Like, it's no different than trying to find a listing. You're just also looking for a deal for yourself, if that makes sense. So anyway, that's my putting a bow on it all.
Love that. And speaking of hustlers and getting a listing, Sam, how'd yesterday go?
Yesterday went well. 2 for 3. It's a big day.
Nice.
Thanks for the shout out, Jeff.
You got it, bro. I love that. That's so rad. If I have Gil and Lauren, I'm going to throw this out to Joe that if anyone three-peats and gets 3 listings in one day, Joe's going to buy him 4 seats to a Knicks game. Joe doesn't know that's the new rule, but I'm just throwing that out there. I want you guys to know that.
We've already decided it's happening. I like it.
I love it. Let's
My,
ride.
my big motivation, Jeff, is sending you pictures of when we lock down some deals. So it's awesome.
I don't know how or why we started that, but I love it. Anytime Sam and I sign a listing, we send a picture, a selfie of us with the signed listing agreement. It's I don't know. It's kind of ridiculous. It's kind of fun. Well, yeah. Anyone else have any questions? All right, that's all. Lauren, let's.
Hey, thanks, Brad.
Hey, you're welcome. And guys, I think whatever, maybe Lauren, you can share my info. You got welcome to ping me or ask questions if you do. Like I like kind of exploring this stuff. This is a bit more kind of in the weeds than we were last week, but like if you're on this call, you're obviously interested. So yeah, man, just get into action and man, it's the best.
I guess I got one real quick thing with the HELOC stuff. Is there anything that you should know, like prepping to go to a bank, or are there banks that specialize in that, or get better rates, or like what should I prepare to set that up? Because
Sure. Well, in keeping with our theme, it really depends. So what I would say is it depends on if you're doing a cash out refi at the same time or if you're keeping your first mortgage. So with me, I originated my home equity line when I did a refinance on my first at the same time. I have another buddy who already is like, he's like 12 years into like his first mortgage and it's like at a good price point, but he's got a ton of equity. So he's going to originate what's called a standalone home equity line.
Okay.
So, you'll want to look at which banks will give you the most amount of leverage, right? Like some people only lend up to 75 or 80%. Some people it's interest only, some people it's fixed. So I just wanted to get the biggest line that I could. And so I leaned on Bank of America, who are like the worst. But they gave me this HELOC. So, and it's interest only. My buddy just got one that was like fixed. So I guess it would say is it depends on if you're refinancing your first, if you're cashing out, and then what you're looking for.
Probably thinking about it as the renovation money or acquisition money on a property or something like that, like to be able to have that without going through a loan process, like money that would be on hand plus that would be like, that's what I would use to acquire a property or whatever. And then if I was able to do a cash out refi on it or whatever.
That's 100% what I do. So yeah, I mean, my house, yeah, I have a $600,000 first mortgage, and then they gave me a $355,000 HELOC because my house appraised at 1.2 something or whatever, right? So I basically did a live-in BRRRR on my own house. Like that's how I did it, right? We bought it, we renovated it, I forced the value, I refinanced my first, and then because I had 600 grand or whatever in equity, I was like, well, I don't want to have this sitting here. This is at the time was like all of my wealth. I was like, well, let me get this HELOC, and then I can use that to do other stuff.
So I'm in the process of getting a HELOC literally as we speak. My wife and I were working out last night, and I'm reading this book right now that Brad had mentioned, The Long Distance Real Estate Investing. And to answer your question, Gil, it was kind of funny. They broke it down for someone that has no idea what they're doing. And it was like, the answer was so obvious, right? It was like, improve your DTI, right? Get rid of some debt and increase your income. And if you can't do that, improve your loan to value, right? Have some equity in your house or purchase a property and let it appreciate. And then so is DTI, loan to value, and credit. Like just improve those three things the best you can, and you're going to improve your chances of getting a HELOC. And like, it was like, oh, well, no shit, I've been doing this for years. That's how you get a loan, right? DTI, LTV, and credit. Like, that's it. So it was an oversimplified answer. I kind of made me feel silly when I read it. I'm like,
it's something I like should have in place, but haven't done yet. And then it's
Same.
like,
Same.
and then a property came up across the street from our other property, and we were exploring a construction loan on it. And I was like, the fees on the construction loan were just a little excessive, where I was like, look, if we just had this, if we had a HELOC set up, if we could acquire the property and then use that, it'd probably be more favorable over time and just simpler.
totally. And like people that have them, the answer is always the same. I'm always like, duh, yeah, of course you should have that, you know? And it's like, God, well, why don't I yet?
All right, cool. Thanks so much, Brad.
Thanks, Brad.
Thank
Of
you.
course, guys.
Thanks, Jeff.
Good luck.
Thank you, Brad.
Thank you.
Appreciate it. Thanks, Jeff.
Thanks,
You
Brad.
guys.